Imagine waking up one day and realizing that the money in your wallet, the dollars you've worked so hard to save, have slowly been losing their value. This isn't some dystopian future. It's the reality we've been living in since 1971. So what's really going on with our money? Let's take a deep dive into this financial mystery. Back in 1971, something monumental happened. President Richard Nixon took the US dollar off the gold standard. Before that, every dollar in circulation was backed by a specific amount of gold, which helped to keep its value stable. It was like having a safety net, ensuring that our money retained its worth. But Nixon ripped up that rule book, setting off a chain reaction that still affects us today. Why did Nixon make this move? The world was changing rapidly. Countries were increasingly demanding the US pay its debts in gold, and America's gold reserves were depleting fast. By taking the dollar off the gold standard, Nixon aimed to protect the country's gold reserves. However, this decision unleashed a torrent of consequences that reshaped the financial landscape. Without the gold standard, central banks, including the Federal Reserve, could print money without restraint. Imagine a baker who keeps baking bread without worrying about how many people actually want to buy it. Eventually, the market becomes flooded with bread, and its value plummets. The same thing happens with money. When more dollars are printed, each one buys a little less, leading to inflation. This endless printing of money creates a widening gap between the rich and the poor. The wealthy, with their access to investments and assets like real estate, can ride the wave of inflation. They can borrow money cheaply, invest it, and watch their wealth grow. Meanwhile, the average person, diligently saving their dollars, sees the value of their savings erode over time. So, what's an average investor to do? According to financial expert Robert Kiyosaki, the answer lies in a timeless asset: gold. Unlike paper money, which can be printed endlessly, gold has a finite supply. This scarcity gives gold a unique resilience against inflation. Throughout history, gold has been a reliable store of value, weathering economic storms and maintaining its worth. Let's journey back to a significant period, the tumultuous years between June 2005 and early 2011. The US stock market was on a roller coaster ride, particularly during the infamous 2008-2009 financial crisis triggered by the subprime mortgage meltdown. During this time, the S&P 500 index, a benchmark for American stocks, delivered a rather underwhelming return of just 9%. Meanwhile, gold prices skyrocketed by a staggering 233%. This historical example perfectly illustrates Kiyosaki's point. When traditional investments like stocks take a beating, gold can offer a shield against inflation and market volatility. But why is gold so special? Kiyosaki points to three key attributes that have cemented gold's value for millennia: scarcity, imperviousness, and malleability. Gold is scarce. There's only so much of it to be found. This inherent rarity makes it valuable. Gold is also impervious to the elements. Unlike paper money that can rot or digital data that can be corrupted, gold is remarkably stable. It doesn't rust or tarnish, ensuring that its value transcends generations. Lastly, gold is malleable. Its softness allows it to be easily shaped into coins or bars, making it a practical medium of exchange. These qualities are why ancient civilizations, from the Incas to the Chinese, recognized gold's worth. It wasn't magic or coincidence. It was a matter of practicality and resilience. In a world of fake money schemes, gold stands out as a reliable store of value, a beacon of stability in a sea of financial uncertainty. Even the most well-funded and well-informed traders on the planet, central banks, are on a gold-buying spree of unprecedented proportions. Central banks around the world are purchasing gold at record levels and reclassifying it as a Tier 1 asset. This indicates a strategic shift, potentially signaling a growing recognition of gold's importance as a long-term financial instrument. Central banks wouldn't be accumulating gold at such a dramatic pace if they didn't see its value in the face of potential economic turmoil. So how can you, the average investor, incorporate gold into your investment strategy in this digital age? Thankfully, it's easier than ever. One popular option is the SPDR Gold Shares ETF, ticker symbol GLD. This exchange-traded fund offers several advantages. 1. Easy to buy. You can buy GLD just like any stock through your brokerage account. There's no need to physically store or transport gold bars. 2. Low fees. With an annual expense ratio of only 0.4%, GLD offers a cost-effective way to get exposure to gold prices. 3. Price tracking. GLD directly reflects the price movements of gold bullion, making it a straightforward way to participate in gold's potential upside. 4. Optionality. For more advanced investors, GLD even offers options trading, allowing for potentially amplified returns and risks. Kiyosaki raises a compelling argument about the potential pitfalls of fake money and the enduring value of gold. Whether you fully embrace his perspective or not, one thing is clear. In a world of ever-increasing inflation and financial uncertainty, including some gold in your investment portfolio might just be a prudent move. After all, even the central bankers seem to be taking a shine to the lustrous metal. In conclusion, our money system has drastically changed since 1971, leading to significant economic consequences. While the rich may find ways to benefit from this system, the average person's savings are at risk of losing value. However, by understanding the unique properties of gold and incorporating it into your investment strategy, you can potentially safeguard your wealth against inflation and financial instability. Thanks for watching, Economic Hero. If you found this video insightful, make sure to like it and subscribe to our channel for more content on how to navigate the financial landscape and protect your hard-earned money. Stay informed, stay ahead, and as always, stay financially savvy.